Question 1. Which of the following best defines the concept of residual disability under an individual disability insurance policy? A. The insured is unable to work in their own occupation but can perform another occupation. B. The insured is partially disabled, continues to work in a reduced capacity, and earns less income. C. The insured is unable to perform any occupation due to a severe disability. D. The insured qualifies for disability only after the elimination period has passed. Answer B. Explanation. Residual disability refers to a condition where an insured individual can still work but in a limited capacity, leading to a reduction in earnings. It is not total disability but partial disability that allows the insured to receive benefits proportional to their income loss. Policies often define this as the inability to perform some but not all of the duties of one's occupation. Options A and C relate to an own occupation or any occupation definitions of total disability, while option D refers to policy provisions like the elimination period, which are separate concepts. Question 2. Under Maine state regulations, which of the following actions by an insurance producer constitutes twisting of A. Offering an incentive to a client in exchange for purchasing a disability insurance policy. B. Replacing a current policy with a new one using misrepresentation to induce the policyholder. C. Making false or misleading statements about a competitor's disability insurance product. D. Failing to disclose exclusions within a disability insurance contract to the policyholder. Answer B. Explanation. Twisting is the unethical practice of inducing a policyholder to replace an existing insurance policy with a new one by using misrepresentation or incomplete comparisons. Maine's insurance regulations classify twisting as an unfair trade practice as it often misleads consumers into purchasing less suitable or more expensive coverage. Option A describes rebating, while C pertains to defamation, and D is a failure to disclose policy terms, which falls under misrepresentation but not twisting specifically. Question 3. Scenario question. James, a self-employed carpenter in Maine, suffered a back injury that prevents him from working full-time. His disability insurance policy includes a waiver of premium rider and a residual disability benefit. If James can now work 20 hours per week instead of his usual 40 hours, leading to a 50% loss in income, what benefits should James expect under his policy? A. Full disability benefits since he is unable to work his normal schedule. B. No benefits because he can still perform some work duties. C. Partial disability benefits proportional to his loss of income along with waived premiums. D. Only a waiver of premium with no disability income benefits. Answer C. Explanation. Under the residual disability benefit, James qualifies for proportional benefits based on his income loss due to partial disability. Since his injury caused a 50% reduction in income, the policy will pay benefits corresponding to this loss. The waiver of premium rider ensures James does not need to pay policy premiums while receiving benefits. Option A relates to total disability, which does not apply since James can still work part-time. Option B ignores the residual disability provision, and option D excludes the income benefit, which is incorrect. Question 4. Which of the following accurately describes the definition of own occupation ECA disability insurance policy? A. The inability to perform the duties of any gainful occupation for which the insured is reasonably suited by education, training, or experience. B. The inability to perform the material and substantial duties of the insured's regular occupation. C. A policy provision that allows the insured to purchase additional coverage in the future without medical underwriting. D. A rider that guarantees benefits even if the insured can work in a reduced capacity. Answer B. Explanation. Own occupation defines disability as the inability to perform the specific duties of the insured's regular occupation. This is a favorable provision for professionals who may still be able to work in another field but cannot perform their original job. Option A describes any occupation, a stricter definition. Option C refers to the future purchase option rider, and D aligns more closely with the residual disability benefit. Question 5. Under Maine's insurance laws, what happens when an insurance producer engages in rebating? A. The producer provides a misleading comparison to replace a policy. B. The producer gives a client a portion of their commission as an incentive to purchase a policy. C. The producer fails to disclose material policy limitations during a sale. D. The producer pays a claim without proper investigation. Answer B. Explanation. Rebating involves offering or providing something of value, such as a portion of the producer's commission, to induce a client to purchase a policy. This practice is prohibited under Maine's Unfair Trade Practices Act. Option A describes twisting, C involves misrepresentation, and D relates to claims settlement violations but not rebidding. Question 6. Which of the following factors primarily affects the premiums for an individual disability insurance policy? A. Marital status and occupation. B. Occupation, age and elimination period. C. Occupation, state of residence and pre-existing medical conditions. D. Policyholder's net worth and education level. Answer B. Explanation. Premiums for individual disability insurance are primarily influenced by the insured's occupation, age, and the selected elimination period. Occupation impacts risk as hazardous jobs often face higher premiums. Age affects mortality and disability risk, while a longer elimination period lowers premiums. Option A includes marital status, which is irrelevant. Option C adds a state of residence, which applies more to state-regulated provisions, and D includes net worth, which is unrelated to premiums. Question 7. Scenario question 0. A 40-year-old software engineer in Maine purchased a non-cancelable disability insurance policy 5 years ago. Recently, she was diagnosed with a chronic illness that prevents her from working for 6 months. During this period, the insurer increases premiums for other policyholders with the same risk class. What happens to Sarah's premiums? A. Sarah's premiums increase because the insurer adjusted rates for the entire class. B. Sarah's premiums remain unchanged as per the non-cancelable policy terms. C. Sarah's premiums are refunded because of her chronic illness. D. Sarah's premiums are waived permanently due to her inability to work. Answer B. Explanation. A non-cancelable policy guarantees that premiums will not increase and the policy cannot be cancelled as long as premiums are paid. This offers strong protection for the insured. Option A describes a guaranteed renewable policy where class-based rate increases are allowed. Option C is inaccurate since refunds are not provided. Option D refers to the waiver of premium rider, which may apply temporarily but does not permanently waive premiums unless specified. Question 8. In group disability insurance, how are benefits typically treated for tax purposes if premiums are paid entirely by the employer? A. Benefits are fully taxable to the employee. B. Benefits are tax-free to the employee. C. Benefits are partially taxable depending on the employee's income level. D. Benefits are taxable only if the employee receives Social Security disability income. SC. Answer A. Explanation. If premiums for group disability insurance are paid entirely by the employer, any benefits received by the employee are considered taxable income. This aligns with IRS regulations on employer-paid disability plans. If the employee pays the premiums with after-tax dollars, benefits would be tax-free. Options B and C are incorrect due to this clear distinction, and D introduces SSDI, which is unrelated to employer-paid group policies. Question 9. Under Maine workers' compensation laws, which type of benefit applies when an injured employee can work in a limited capacity but experiences reduced earnings? A. Temporary total disability TED. B. Temporary partial disability TPD. C. Permanent total disability PTD. D. Permanent partial disability PP. Answer B. Explanation. Temporary partial disability TPD benefits apply when an injured employee can work but in a reduced capacity, leading to lower earnings. These benefits compensate for the wage loss during recovery. TTD applies when the employee cannot work at all temporarily. PTD refers to a permanent condition preventing all work, and PPD applies to permanent impairments with some ability to work. Question 10. What is the primary purpose of the waiver of premium rider in a disability insurance policy? A. To ensure premiums are waived if the insured becomes totally disabled for a specified period. B. To provide additional benefits for a limited time when disability begins. C. To allow the insured to purchase additional coverage without underwriting. D. To adjust benefits for inflation over time. Answer A. Explanation. The waiver of premium rider waives premium payments if the insured becomes totally disabled for a specified period, e.g. 90 days. This provision ensures the policy remains in force without financial strain on the insured. Option B refers to additional monthly benefits. C is the future purchase option rider, and D describes the cost of living adjustment COLA rider. Question 11. Which of the following provisions in a disability insurance policy allows the policyholder to increase coverage without medical underwriting at specified intervals? A. Guaranteed renewable. B. Future purchase option FEO. C. Waiver of premium. D. Cost of living adjustment COLA. Answer B. Explanation. The future purchase option FEO rider allows the insured to increase their coverage at specific intervals, e.g. every 5 years, without requiring medical underwriting. This is beneficial for individuals whose income increases over time. Option A refers to a renewable policy but does not allow coverage increases. C relates to premium waivers due to disability. And D refers to adjusting benefits for inflation, not coverage amount. Question 12. How does the own occupation definition of disability differ from the many occupation definition in a disability insurance policy? A. Own occupation pays benefits if the insured cannot perform any job, while any occupation pays if the insured cannot perform their regular occupation. B. Own occupation pays benefits if the insured cannot perform their regular occupation, while any occupation requires the insured to be unable to perform any occupation. C. Own occupation is available for mental illnesses, while any occupation applies only to physical injuries. D. Own occupation applies to group policies, while any occupation applies to individual policies. Answer B. Explanation. The own occupation definition pays benefits if the insured is unable to perform their specific occupation, even if they can work in another field. The any occupation definition is stricter, requiring the insured to be unable to work in any occupation for which they are reasonably suited by education, training, or experience. Question 13. Scenario question. John, the self-employed contractor in Maine, experiences an injury that prevents him from working. His disability insurance policy has a 90-day elimination period and a 12-month benefit period. After 90 days, John returns to light-duty work, but his earnings are reduced by 50%. What type of disability benefits is John most likely eligible for? A. Total disability benefits. B. Partial disability benefits. C. Temporary total disability benefits. D. Residual disability benefits. Answer D. Explanation. Residual disability benefits apply when the insured can return to work in some capacity but experiences a loss of income due to the disability. In this scenario, John is working but earning less, which makes him eligible for residual disability benefits. Option A applies when the insured cannot work at all. B is incorrect, as a partial disability benefits typically refer to conditions that do not meet the criteria for full disability but allow for some work. Option C describes a temporary inability to work completely, which doesn't fit this situation. Question 14. Which of the following statements best describes the tax treatment of disability benefits from an individual policy when premiums are paid with after-tax dollars? A. The benefits are taxable as income to the policyholder. B. The benefits are tax-free to the policyholder. C. The benefits are tax-free if the policyholder is employed at the time of the disability. D. The benefits are taxable if the policyholder is self-employed. Answer B. Explanation. If premiums are paid with after-tax dollars, the disability benefits are tax-free to the policyholder. This is a key feature of individual disability insurance policies, allowing the insured to receive benefits without incurring additional tax liability. Option A would apply if the premiums were paid by the employer. C is unrelated to tax treatment, and D is also incorrect, as self-employed status does not affect the taxability when premiums are paid after tax. Question 15. Which of the following is typically excluded from coverage in a disability insurance policy? A. Disabilities resulting from car accidents. B. Disabilities resulting from pre-existing conditions. C. Disabilities resulting from work-related injuries. D. Disabilities resulting from accidental injuries. Answer B. Explanation. Pre-existing conditions are often excluded from coverage in disability insurance policies. Insurers may exclude benefits related to conditions that existed before the policy's effective date. Option A may be covered unless explicitly excluded in the policy. Option C is typically covered under workers' compensation insurance, not disability insurance. Option D would generally be covered under an individual disability policy unless specifically excluded. Question 16. What is the main difference between a non-cancellable and a guaranteed renewable disability insurance policy? A non-cancellable policy guarantees benefits even if the insured's occupation changes. B. A guaranteed renewable policy allows the insurer to increase premiums based on age or other factors. C. A non-cancellable policy allows the insurer to change policy provisions but not premiums. D. A guaranteed renewable policy cannot be cancelled by the insurer, but premiums can increase based on the insurer's discretion. Answer B. Explanation. A guaranteed renewable policy guarantees that the insurer cannot cancel the policy, but the insurer can increase premiums based on specific factors like age. A non-cancelable policy guarantees that both the premiums and policy provisions will remain unchanged throughout the policy's term. Option A is incorrect because the occupation change does not directly affect policy benefits. Option C is incorrect as the non-cancelable policy guarantees no changes in premiums. Option D confuses the two types of policies. Question 17. In a group disability insurance policy, what is the primary difference between a contributory and a non-contributory plan? A. The employer pays the entire premium in a contributory plan, and the employee shares the cost in a non-contributory plan. B. A contributory plan is mandatory for employees, while a non-contributory plan is optional. C. The employee shares the premium cost in a contributory plan, and the employer pays the entire premium in a non-contributory plan. D. A contributory plan applies only to long-term disability coverage, while a non-contributory plan applies to short-term disability coverage. Answer C. Explanation. In a contributory group disability insurance plan, the employee shares the premium cost with the employer. In a non-contributory plan, the employer pays the entire premium. The employee does not contribute to the cost. Option A incorrectly switches the roles of employer and employee. Option B is incorrect as both types of plans may be mandatory or voluntary depending on the employer. Option D is inaccurate as both types of plans can cover either short-term or long-term disabilities. Question 18. Which of the following is a major feature of the cost of living adjustment (COLA) rider in a disability insurance policy? A. It increases benefits based on the consumer price index to keep up with inflation. B. It guarantees the insured will receive additional benefits for up to 5 years. C. It adjusts premiums based on the insured's income level. D. It provides an additional sum for dependent children if the insured is disabled. Answer A. Explanation. The cost of living adjustment (COLA) rider increases the disability benefits based on a specified percentage or the consumer price index to help the insured keep up with inflation. This ensures that benefits do not lose purchasing power over time. Option B is incorrect as COLA does not guarantee benefits for a fixed period. It only adjusts for inflation. Option C refers to income-based underwriting, not a rider. Option D is unrelated to COLA. It describes dependent coverage under certain policies. Question 19. Under Maine's disability insurance regulations, which of the following is an action that could result in the suspension or revocation of an insurance producer's license? A. Providing clients with a discount for using the same insurer for multiple policies. B. Engaging in misrepresentation or fraudulent conduct in selling a policy. C. Adjusting premiums based on the insured's job title. D. Offering policyholders free legal advice to assist with claims. Answer B. Explanation. Misrepresentation or fraudulent conduct in selling a policy, such as making false statements about coverage, is a violation of Maine's disability insurance regulations and can lead to suspension or revocation of the insurance producer's license. Option A is generally allowed as long as it does not involve unethical conduct. Option C is not inherently wrong but could be if it involves discrimination. Option D could constitute the unauthorized practice of law, but it would not be grounds for suspension unless it directly violates other regulations. Question 20. Which of the following provisions would most likely be included in an individual disability policy for a self-employed individual? A. Overhead expense coverage. B. Temporary total disability coverage. C. Workers' compensation coverage. D. Social insurance substitute rider. Answer A. Explanation. Overhead expense coverage is specifically designed for self-employed individuals and business owners to help cover their business expenses if they are unable to work due to disability. This is critical for individuals who rely on the income generated by their business. Option B applies more to short-term disability. Option C pertains to workers' compensation, which is separate from disability insurance. Option D is related to substituting Social Security benefits, not business-related expenses. Question 21. Which of the following is most likely to be excluded from coverage under a disability insurance policy? A. Disabilities caused by a pre-existing condition that was disclosed to the insurer. B. Disabilities caused by a work-related accident. C. Disabilities caused by participation in high-risk activities such as skydiving. D. Disabilities caused by natural disasters such as earthquakes or floods. Answer C. Explanation. Most disability insurance policies exclude coverage for disabilities resulting from participation in high-risk activities such as skydiving, bungee jumping, or extreme sports. Work-related accidents are typically covered under workers' compensation insurance. Pre-existing conditions may be excluded only if they are not disclosed to the insurer or are explicitly excluded in the policy. Natural disasters are generally not excluded unless specifically stated. Question 22. Which of the following statements is true regarding the tax treatment of disability income benefits in a group disability insurance policy paid for by the employer? A. The benefits are tax-free to the employee. B. The benefits are taxable to the employee if premiums are paid by the employer. C. The benefits are tax-free if the employee's earnings exceed $100,000 per year. D. The benefits are tax-free if the employee is disabled for more than 12 months. Answer. B. Explanation. If the employer pays the premiums for a group disability insurance policy, the benefits received by the employee are typically taxable as income. If the employee pays the premiums with after-tax dollars, the benefits would be tax-free. Option A would be true only if the premiums are paid by the employee. Options C and D are incorrect because the taxability of benefits depends on who pays the premiums, not the amount of the employee's earnings or the duration of disability. Question 23. Scenario question. Anne is a software engineer and has a disability insurance policy that includes a 60-day elimination period. After she injures her back in a car accident, she is unable to work for 6 months. How much will Anna likely receive during the elimination period? A portion of her salary equal to her monthly benefit. B. Nothing, as no benefits are paid during the elimination period. C. A partial disability benefit based on her partial inability to work. D. A waiver of premium but no income benefits. Answer. B. Explanation. During the elimination period, no disability benefits are typically paid. The elimination period is a waiting period that must be satisfied before benefits begin, and during this time, Anna will not receive any payments. Once the elimination period is over, she will begin receiving her regular disability benefits, assuming she qualifies for full disability. Option A and C would only apply once the elimination period is over. Option D is incorrect as it refers to the waiver of premiums, not the payment of benefits. Question 24. Which of the following is a primary characteristic of a graded premium disability insurance policy? A. The premium remains fixed for the life of the policy. B. The premium is lower initially but increases at specified intervals. C. The premium increases based on the policyholder's occupation. D. The premium decreases as the policyholder's age increases. Answer. B. Explanation. A graded premium disability insurance policy typically has a lower premium in the early years, with premiums increasing at specified intervals, e.g., every 5 years as the policyholder ages. This allows the insured to pay lower premiums initially, but the cost rises as they get older. Option A applies to a level premium policy, not a graded one. Option C is incorrect because premium increases are based on age or time, not occupation. Option D is not correct for graded policies as premiums typically increase, not decrease. Question 25. Which of the following provisions would allow a policyholder to continue their disability insurance coverage without paying premiums while they are disabled? A. Waiver of premium. B. Guaranteed renewable. C. Residual disability benefit. D. Cost of living adjustment, COLA. Answer. A. Explanation. The waiver of premium provision allows the policyholder to stop paying premiums while they are disabled, but the coverage continues as long as they remain eligible for benefits. Option B allows for policy renewal but does not address premium waivers during disability. Option C relates to partial disability benefits but does not affect premiums. Option D adjusts benefits for inflation but does not waive premiums. Question 26. Which of the following best describes the elimination period of each disability insurance policy? A. The period of time the insured must wait after disability occurs before benefits begin. B. The time frame in which the insured must recover and return to work after a disability. C. The length of time a disability policy is effective. D. The period during which the insurer can contest the claim. Answer. A. Explanation. The elimination period is the waiting period that must pass after disability occurs before benefits are paid. It is essentially a deductible in terms of time, not money. The elimination period can range from a few weeks to several months depending on the policy. Option B refers to the recovery period, which is not related to the elimination period. Option C is incorrect as it refers to the term of the policy, not the waiting period. Option D refers to a contestability period, not the elimination period. Question 27. Which of the following is typically included in a residual disability rider (ECA) disability insurance policy? A benefit for a partial disability that reduces the insured's income even if they can still work part-time. B. A benefit for disabilities that do not affect the insured's ability to perform their occupation. C. A rider that increases the policy's benefit amount over time. D. A waiver of premium if the insured can no longer work at all. Answer A. Explanation. A residual disability rider provides benefits if the insured suffers a partial disability and experiences a loss of income even if they can still work in some capacity, e.g., part-time or at a reduced level. This rider helps replace a portion of the lost income. Option B is incorrect as residual disability applies to partial disability that impacts income. Option C refers to a cost of living adjustment COLA rider, not residual disability. Option D is related to the waiver of premium provision, not residual disability. Question 20. What is the primary difference between short-term and long-term disability insurance? A short-term disability insurance covers injuries or illnesses lasting for up to 1 year, while long-term disability covers disabilities lasting more than 1 year. B. Long-term disability insurance has higher premiums than short-term disability insurance. C. Short-term disability insurance provides higher benefits than long-term disability insurance. D. Long-term disability insurance only covers permanent disabilities, while short-term disability covers temporary conditions. Answer A. Explanation. Short-term disability insurance typically covers disabilities that last for a short period, e.g., a few weeks to 1 year, while long-term disability insurance provides benefits for disabilities that last longer, usually exceeding 1 year. Option B is generally true but does not define the difference between the two. Option C is incorrect as long-term disability insurance usually provides more extended coverage but not necessarily higher benefits. Option D is incorrect because both types of insurance can cover temporary or permanent disabilities. Question 29. Scenario question. Tom is a 45-year-old Maine resident who works as a surgeon and purchases a disability insurance policy with a own occupation definition. If Tom becomes disabled and can no longer perform surgery but is able to work in another medical capacity, what benefits will Tom Mikey receive? A. Full disability benefits for as long as Tom cannot perform surgery. B. Partial disability benefits for as long as Tom can work in another medical role. C. No benefits since Tom can still work in another medical role. D. Disability benefits limited to a percentage of his earnings from surgery. Answer A. Explanation. The Maine occupation definition of disability provides benefits if the insured cannot perform their specific occupation, even if they can work in a different field. Since Tom is a surgeon and is unable to perform surgery, he would likely be entitled to full disability benefits, regardless of his ability to work in a different medical capacity. Option B refers to partial disability benefits, but Tom qualifies for full disability under the Maine occupation definition. Option C is incorrect as long as Tom cannot perform his own occupation, he is eligible for benefits. Option D is also incorrect as Maine occupation does not limit benefits to the insured's prior earnings. Question 30. Which of the following best describes a non-cancelable disability insurance policy? A. The insurer cannot increase premiums or cancel the policy as long as premiums are paid. B. The insurer can increase premiums only after 5 years. C. The policy can be cancelled by the insurer after a certain period. D. The insurer must provide a refund if the policyholder cancels the policy. Answer A. Explanation. A non-cancelable disability insurance policy guarantees that the insurer cannot increase premiums or cancel the policy as long as premiums are paid on time. This provides the insured with long-term stability in terms of cost and coverage. Option B refers to a guaranteed renewable policy but does not provide the same level of protection as a non-cancelable policy. Option C is incorrect as a non-cancelable policy cannot be cancelled by the insurer. Option D is unrelated to non-cancelable policies.